Okay, hello everyone, and welcome to this final part of the introduction to the price ladder. And what I'm going to be going through now with you guys is some order book trading terms and lingo. So, with this small tutorial series, what we're going to be trying to go through is some of the words that you'll hear on a trading floor and some of the words that I'm inevitably going to be saying while I go through a lot of the price action when we go over some of the replay data, or either when we go just through live market data. Whatever it may be, when you listen to a trader talk about price action, he's going to be saying a lot of words that you probably never heard before. And a lot of the times, you'll actually hear them talking about he was doing this, because they're referring to how that price action was taking place. But let's just start off with the very, very basics. The first thing I want to go through is how you describe a market that has gone from, let's say, 32, let's say it's just gone from 32.32 up to 32.33. So the best bid went from 32.32 to now 32.33. So that means whatever offers were at 32.33 have been so-called lifted. Well, I'll just say that. I'll go through that in a second. But when the market goes up one tick, you say it's gone bid. So go bid slash go offered. So when the market goes bid, it means it's ticked up and it's trading now the next price up. If it's gone offered, it's now trading. What you just saw there, if we just quickly take a look back, if you rewind the video, you'll see that market, it just went from 32.33, it went up, it went bid 32.34. So you say it went bid, or it's gone bid, it goes bid. That's just technically gone offered. So from the best offer being 32.35, it's now the best offer is now 32.34. So that's again what you saw in there, that last move. It's gone offered again from 32.34. Best offer is now 32.33. So that's gone offered. Gone offered. And that's how you would describe a market that's basically moved up or down a tick, or you could say it was going bid continuously. So that means that it was going bid up consecutive prices. That's just a way to describe the price action. Now the next kind of lingo, or it kind of goes along with what I just said, is how the market does this. So if a market goes bid, that means technically the offers were lifted. So you say lift the offer slash hit the bid. So if you were, let's say, an intraday trader and you wanted to get long this market aggressively, and you wanted to do that at market, and you could do that by lifting the offers. That's what you would say. You say if you wanted to get long, let's say 3 or 4 contracts, whatever it may be, you're going to have to lift at this price. Well, now the market price is 32.32. You lift any contracts that are available at that best offer. Now, if you were a market participant that now wants to sell, which someone just did there, at 32.30, you're going to, what we say is, hit the bid. So hit the bid to go short, and lift offer to go long. And that is very, very common. That's something you'll hear all day long on the trading floor. I came in, I lifted the offer, the market went bid. That in conjunction. You'll hear these things in conjunction almost interchangeably all the time. So I hit the bid and it went offered. That's an ideal scenario. Or you hit the bid and then it went bid, which means now you're offside. So if you start understanding these little dynamics, when I start talking about this really quite quickly, when we start going through certain price action setups, especially when we talk about aggressive breakout moves, you'll see I talk about this very quickly. It's very important for you to understand what going bid, going offered, lifting offer, and hitting bid means. Just make sure you understand that, ingrain that. A small little aspect. So if, for example, I was aggressive and I wanted to take out all these contracts here, 87. Let's say it's 100 contracts. There's 100 contracts on the bid, and I want to hit the bid with 100 contracts. Everything that's on the bid I want to take out. That's called a sweep. If you want to sweep the bid, you take out everything there, all 900 contracts there. If I want to sweep the offer at 32.32, I've got to lift 700 contracts, let's just say, because it keeps changing. So if you want to take out everything on the bid or the offer, you call that a sweep. Not something particularly used by small traders. So it'll, once you reach a certain size and you can actually do that, that's where you actually use a sweep. I know for a fact that a lot of institutional players, I've got some friends that worked in investment banks, and they have to execute trades. If a client tells them to sweep, or if that's something that's at the discretion, they want to sweep and take out all of the bids or offers, that is a tool that they can use. So, something to just be aware of. They can sweep. So we'll just put that in just below here. Sweep. You take out everything on bid/offer. Then, the next thing we want to talk about is, let's just say the market, it's currently trading, let's say 32.31 bid and 32.32 offered. That's another thing you'd have to understand. When you're quoting prices, you want to make sure you understand how to quote them. So when you quote the price, the current prices that are trading right now, it's 32.31 offered and 32.30 bid. So 32.30 bid, 32.31 offered. And obviously, I don't know these intricately. This is something, if you traded, let's say, in the pits, you would have said things probably like 32.30 bid at 32.31 or something along those lines. But the most important thing to understand is it is bid now. It's currently bid at 32.30 and offered at 32. Now again 32.30. It's 32.29 bid, 32.30 offered. These are just something, just a way to quote. So when you quote, sorry, make that the same color. So quote price as bid at / offered at. Then we've got, let's just say for argument's sake, we've got a big trader at 32.32, for example. If the market had traded up to 32.32, let me just put this in a darker color. If the market had traded up to 32.32, and for whatever reason, it was trading into it, couldn't really get past it. It was refreshing, reloading. You could say it's an iceberg, whatever you want to call it, but you could also say that there's someone sat at 32.32 on the offer. Or you could say someone, again, likewise, if someone was selling into 32.29 now at market, and this kept refreshing, you could say someone is sitting, this is in the present, sitting on the bid. Basically just means someone big is sitting there absorbing it. You're just sitting there and absorbing it, taking it, just literally taking it on the head, no problem. And that's usually when you've got someone big doing a big order. So if you say someone's sitting on the offer with a lot of size, that means he's got a lot of orders to execute at that particular price. And it's important to understand that information. If someone screams out on the trading floor, someone's sitting heavily at 32.32, you want to be aware of that. If someone says that, you need to understand what that means. That means there's a big seller at 32.32. Maybe I'd like to sell with him. Maybe I'd like to sell at market in front of him. But that's quite an important little lingo term that a lot of people use. So like we just said, sitting on bids slash offers often means reloading slash absorbing. Now, let's move on to the next little lingo term, or terms as we would say, is something called ticking up and ticking down, or you could also say uptick, downtick. They don't necessarily mean the same thing. If you say a market's ticking up, you just generally mean that the market is moving up. So if you say the market is ticking up slash down, it just generally means, sorry, this is the wrong, just give me a second there. So market ticking up slash down. What that means is if the market's ticking up, it just means that it's steadily moving up, 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 up. When it's ticking down, it just means that it's just generally ticking down. Now an uptick, not necessarily mean it's ticking up. An uptick or a downtick, for example, we usually use this term when, let's say, we're trading at the low of the day. So, for example, if we were trading at or near the low of the day, and someone would say on the trading floor, okay, someone just downticked the low. So if, let's say, we were bid 32.21 and offered 32.22, then let's say we were, bid here and offered here. So all the offers are up here and all the bids are here. This is our market price. You could buy at market here, sell at market here, and then we went offered. So this moved down one price, and then this moved down as well. So the best bid was here, the best offer was here. And if this was the low of the day, as we currently see here, as is currently already indicated in yellow, a downtick would mean someone just sold at market at 32.20. It would essentially make a new low of the day. It doesn't necessarily mean it's gone offered 32.20. So the best offer is still 32.21, but it's just downticked that, and you'll probably see even on the volume profile, let's say you get a downtick of, let's say, 2 lots, or I don't know, 5 lots. It's sometimes, let's say, someone that's been long up in here, he's got a little stop loss order, he just pays down and gets stopped out. So that's what an uptick or downtick is. It doesn't necessarily have to be at a high or low, but you usually use that when you're trading at a high or low, or an area where you're looking at a potential breakout. Now an uptick could be in the middle of the range. Now you could see someone come in and just uptick the price. That means someone's just literally just traded at market at. So for example, now if we just take a look at what the price is doing now, that was an uptick. Someone just upticked 32.36. A downtick, likewise, if someone just trades at market at the price below. So that's how you would use, let's say, the uptick or downtick terminology. And it doesn't necessarily mean it's ticking up or ticking down. A steady tick up, when you say that, it means it's kind of moving up progressively. An uptick is just a trade at market. So I'll just put here versus uptick slash downtick. And move over to the next little bit of Lingo. And this is particularly if we're looking at bigger market participants that come in with size on the order book, and you can actually see them with size on the order book. If, for example, we were looking at a particular buyer at, let's see if we can, well, no one really big here, but let's just say the biggest one I can see right now, it keeps changing continuously, but right now 32.32, this price keeps showing up. There's about 1,500 contracts here, 1.5k contracts here, and let's just say he moves this bid up, and this bid now gets even thicker, and it moves up to about 3k. Someone big basically pushing his bids up. Now, when you say, when you're looking at that buyer and say, come on, man, just pay up. Pay up already. When you say pay up, you mean you're basically saying you want this guy that's basically bidding the market up. You want him to pay. You want him to pay the price. You want him to pay at market. Pay up. Stop, joining the bids and just pay up at market. That's essentially what you would say. Now, likewise, you can also say pay down, although some of the older traders in the industry will argue against it and cringe if you say pay down. This happened the other day in the trading floor. I was looking at a particular a breakout trade to the downside, and there was a pretty big offer here at market. Let's just say for argument's sake, there's a big offer, and I was looking for the market to break lower, and I could see him moving down. I just shouted out, pay down, pay down. And one of the directors of the firm, Dan Goldberg, turned around and was just like, you cannot say pay down. It doesn't exist. He'll argue the only way you can say pay is if you're buying. Technically, you're accepting a price if you're selling it. But in any case, you will still hear people on the trading floor that are quite a bit more experienced than I am still say that on the trading floor. Pay down when a big market participant or any sort of market participant, instead of joining the offer or joining the bid, goes to market and it's aggressive. So what we just mentioned there, pay up slash pay down. Put a little exclamation, pay up, pay down. The next little, let's say the next important lingo term that I wanted to cover really quickly is a high slash low volume node. Now, if if you trade using market profile, which is something we don't cover in this price ladder course, but if you're on the virtual trading floor training or even on the trading floor training, you will know if you're going through a market profile through, you understand what a higher low volume node is. But I'll go through it for the sake of argument anyway, because we can see it on our total traded volume price over here. We get this volume profile on the right here. So if we just point out what an actual high volume node is, a high volume node is basically where a lot of volume has been traded. So comparatively, obviously it's very subjective and very relative, but this price here, again, this is obviously a reason why 32 kept popping up in a lot of these videos, is because there's a high volume, a lot of traded volume there. That is the highest volume traded price for the day. Consequently, we will also call that a VPOC. So this is often called a VPOC, volume point of control. You don't really need to know what that is yet. You won't cover it in the course, but if I ever mention VPOC on the course, just take it as a very high volume node. It's the highest volume node of a day. Um, so that is a VPOC. That's a high volume node. And a low volume node, for example, in the midst of all these volume nodes, you can see this particular price, 32.49, is a low volume node. Only 718 contracts traded there, an LVN. So we call this an HVN and an LVN. So I probably won't even say high volume node. I'll probably just say HVN if I ever mention it. Just understand I'm saying a high volume node. Then, moving on to just one quick little thing that I'd like to mention. Obviously, it's important if um, you don't really want to be in these situations ever. But if you are, you know, you can mention the word puke. Quite a horrible word, I know, but that often just means um, if you're in a position and you're offside. Let's just say, for example, you're long this contract, so you've bought the market at 32.39. The market travels lower. Your stop is at 32, 32.29. Once you get out of that market, once you've covered it for a loss, you puking, you've puked out of your position. You never say puke if you're getting out for a winner. Puke is only really if it's only when you're taking a loss. And usually puke, traders often say it when they're taking a bigger loss than they want. It just can't go any further, and it's just basically the maximum price they'll pay for being in that trade. So this is you often use this though for larger traders when bigger trader takes into a position and he's just puking his big position. He's getting out of the market and just at market just taking everything out. So it's taking a loss on a trade, usually a large trade and usually a large loss. Finally, a few more things I want to go through. A spread. One second, let me just change this color a bit. What's going on there? Why is that not working? Just bear with me for a sec. Seem to have this problem quite often. In any case, we'll just move that back up there. Sorry, thank you very much for bearing with me. Just quickly go back to what I was saying. So, oops, get that pen go again. There we go. And here we go. What we're going to say is spreading. Now, what is spreading? You'll often, hear me say this if you're trading two different markets. Spreading basically involves you taking a position in one market versus another market. It's a relational trade. It's a relative value trade. So often, it involves two legs. You buy one product and sell another product. And, obviously, you can sell one lot, two lots versus another two lots, or it could be 2 versus 3, 2 versus 10. It really depends on how you're spreading. But in any case, it's always a spread. It always involves two parts of a trade. You buy one product and sell another product. And often, if you're trading, for example, you don't necessarily see many spread trades in the equities. You can get them, but often you'll see spreads in bond markets. So, the 2-year versus the 5-year, or the 5-year versus the 10-year. You might get the 2s versus the 30-year trade. So basically, a spread is one position versus another position, and that's basically how you would uh, when you say spread, it basically means you've taken a leg on one and a leg on the other one, and you'll hear it a lot on the trading floor because obviously on our trading floor, 90% of our traders are actually outright traders, and more often than not, they're actually quite pissed at the spreaders because they tend to, um, either ruin their position. It's not really something right to be saying, but in any case, you do hear a lot of people, oh, it's the spreaders are doing this, there's a spread trade going through, but it is important to understand because you can actually see sometimes the spreads are going through, and it's important, especially if you're trading the bond complex. I'll get into a little bit more detail on some other setups that I might go through. Now, the last two things that I want to go through, and um, they're basically to do with types of setups. We're just going to cover them together. So breakout, and a lot of traders have probably ever heard of this already. A breakout trade obviously depends, is when you've got a level and the market's moving through that level. So if we just draw on the right here, if we've got, let's say, a market that's trading within this range, and then we get the market trading up to that range, the breakout is a breakout of this level. A breakdown, similarly, if we say we've got the range, the market traded in this range yesterday, and then today we come into the market. Sorry, let's just make that different color. The break point, we've got a breakdown at this level. This is, let's say, the low of the day. This is our high of the day. A breakdown is when we break through the low of the day, or a breakout is through the high of the day. It doesn't necessarily have to be high or the low, but a breakout is basically breaking a certain area and pushing away from that area. That's essentially what you would mean by a breakout. Now, conversely, you have what's called a fade. And that's basically when you go against what the market's doing at the current moment. So for example, if we had a market trending lower and you had a very, very important level, you just look, you add up this level, it's a really good level, you say, I want to buy 32.27. The market's kind of trending and pushing down into your level. A fade is if you bought the market against its current price action. The current price action is down, you're fading it, you're going against it. It's a contrarian trade. That's what a fade means. A fade is a contrarian trade. So that's technically what a fade is, and you'll see fades on price action. For example, if you see a false breakout and the market comes back in, you're fading it, and then hopefully you'll get a move back up. Likewise, you can fade something that's going up. You can be trending up. You have a very, very important level at this level here. You want to sell it as the market is moving up. So the market's moving up. You want to sell it, and as you're selling it, that is a fade. And you'll see fades. You can characterize them as false breaks, head fakes, fakies. There's loads of different setups. I'm not going to go through all of them, but essentially the term you need to understand is a fade. Contrarian trade. A breakout is going with it. Usually with breakouts you're looking for momentum. But we'll go through these in a little bit more depth when we get to these price action setups. Essentially, like we've said before, the key and the objective of these price ladder videos, as we go through this price ladder course, we're trying to build you up into a Futex trader, into a trader that can trade these setups. And these are part of the setups and part of the setup arsenal. You have to understand what these breakouts are because they're very important, and fading as well. We'll get to that. That's also a separate module, and how to identify good levels and trade off of these levels as well. Thank you very much. Stay tuned for the next video, the next modules. We'll be going through further price action, further price ladder, and delving into further analysis of how to use a price ladder in trading. Thank you very much for listening.